All right, everybody, I'd like to introduce you to our special lunch presentation here today. So I've known Maj now for quite a few years. I think it's like 4 years now. And I really have always admired his work and think he's one of the best in the business when it comes to microcap investing. He has a tried and true strategy. He's great writing staff working with him over at GeoInvesting.com. I think some of you are subscribers to his stuff here. So without further ado, let's learn about what Maj owns in this special lunch presentation. Maj Soueidan, GeoInvesting.
Thank you, Bobby. So just a little bit about GeoInvesting if you haven't heard of our company. I've been a full-time investor for about 30 years now, mainly investing in small companies, microcaps. We launched GeoInvesting about 12 years ago to bring organic research to our membership base, as well as write critical pieces on companies that we feel are not really telling the truth. Their management teams are a little dishonest. So I think we've gained a little respect because we've done both of that. But we're mainly long, we're mainly bullish, and we love microcaps. Now, you're all here because you understand the value of investing in microcaps. You understand that there's a lot of negative stereotypes out there, and there are definitely a lot of bad companies out there, bad actors, but there's a lot of great companies. There's 20,000 stocks trading in North America, almost half of them are microcaps. So the hunting ground is fertile to find great companies. So today I'm going to go through some companies that I own all these companies. And we'll see how many I get through. I have about 4 queued up here. And it proves that there are great companies, high quality companies that trade as microcaps. And so that's, we'll start here. Now, there's something here, if you know, let me use a slide presentation over here. You've heard of Jim Collins, Good to Great. I borrowed this from Ian Castle's presentation of the Microcap Club when he was talking about the goals of his company. He brought up the BHAG and what he wanted the club to be like in several years from now achieving multi-baggers over time and how many he wanted to achieve. So I thought about that, and I'm not going to get too much into the deep stats here of the companies I'm following. I want to talk more about some of the catalysts, the inflection points, some of the tailwinds, some of the struggles the companies went through, and some of the changes they made to be where they're at today. And so I'm going to basically try, or I am actually going to show for each company one slide. I call it the big, hairy, audacious fact. The one fact, the one slide that really tells the whole story. So when we go through the presentation, and we're going to try and build to that a little bit. So let me take you to this chart over here. So this is a chart of RWWI, Rand worldwide. $5,000 invested in the stock in 2010 will be about $57,000 today. I think that's about was about a 34% compounding annual growth rate. So how many have heard of Autodesk here? Okay, so Autodesk is maybe a top 5 seller of engineering and design software. So the software is used for to help design buildings, design products, but it also helps organize. It helps to archive. The software helps to archive data, archive images, archive just any information, and then have it available to be able to revisit it again, to make strategic decisions, make changes, and see how things are going with the product. If they got to make changes, and if they have to make changes, they know where to find it. And then basically the software allows the user to view all this in one really easy kind of format, so they have them to go to different places. So that's kind of the crux of what they do, or at least what RWWI does. Now RWWI, I did come across the stock in 2010, but my $5,000 didn't turn to $2,000. I didn't buy it then, and there were reasons I didn't buy it. There were just things I didn't like about it. It was a reseller. I don't like to invest in resellers because of the low margins that are inherent with resellers. I thought it was overvalued, so I kind of just put it away and never looked at it again. Then I came across my plate not too long ago, and I said, let me look at this again and see what's going on. I took a deeper look at it, and then I understood why the stock has done what it's done. So there's a notion here that resellers are crappy companies, low margins. There's a lot of debate about where resellers are going in the future because there's a lot of companies now going to the cloud and selling direct and abandoning their resellers who help them sell their products. But when you take a closer look at what RWWI does for Autodesk, if you go online, you'll see a lot of customers talking about Autodesk resellers, the value resellers add, and there's a difference between a reseller and a value-added reseller. So a value-added reseller offers customer support, actually offers other products that can work with the software that they're reselling, that the host company maybe won't offer. So that's a real advantage that a company like RWWI offers. So, and when you take a look at what's going on in the industry, this is kind of interesting. Oh, actually, I'll show you some. Before I do that, I'll show you some overview. Here's some stats on RWWI here, so you can see what it's trading at 60. I bought it a couple weeks ago, or a few weeks ago, at $4 or something. They just reported earnings a couple days ago. Here's some of this. We'll come back to this later.
It has $1 billion in cash.
Can you believe that?
That's terrible.
Well, actually, it was $4 million last year, so it's come down. They've historically, and they've historically operated on a low cash, low current ratio through all their history. So that was one thing we looked at, and that was a caveat I was looking at. But they've done well. They've been able to manage. Their collections are good, and they have a lot of recurrent revenue, which is another reason why they can operate like that. So we'll go over here. So here was some of the customers. Some people around the web say about resellers, and they kind of affirms what we just talked about. And then we go over here. So there's some tailwinds here going on now in this industry that are pretty interesting, which is, if I would have looked at this in 2010, I would have maybe seen this. So Autodesk is changing its business model. Autodesk historically has sold their services through a perpetual license on-premise model. So they sell a customer a license, maybe through an RWWI, usually, typically, because 70% of Autodesk's revenues typically come from resellers. So it's a lumpy business. They get a big payment up front. The customer then owns a license for a period of time. But the trend now, obviously, for everywhere, you hear this recurring revenue. Everyone's going to SaaS. Everyone's going to cloud. So Autodesk decided to make that move a few years ago, and doing that is disrupting the industry to some degree, and for some in a good and some in a bad way. The small resellers who didn't prepare for this, who didn't anticipate this, are either going to disappear or are going to be gobbled up by larger resellers. Now, Autodesk has made it clear that they're not going to issue perpetual licenses for most of their products anymore. So you're going to be forced to have to basically use what you have and get no support from the software you might have had in the past, or transition to this new model the SaaS model they're putting forth, and download the product and start getting involved that way. So that's why a lot of these resellers the small resellers are not happy about what's going on. And this is actually a quote from a company in the UK that is talking about how this is negatively affecting them, and kind of affirms that. Now, RWI has got to give them credit. They've been preparing for this for a long time. What's interesting here is what's going on here. So the company has made a lot of acquisitions since they went public, and I think they knew this was going to happen one day. So they've become a top reseller for Autodesk, and there's actually a guy an individual who's opined on this a little bit. Let me see the slide. This is telling you what's happening in the industry, basically consolidation. And he's basically saying that all these small resellers are going to be gobbled up by bigger resellers, and eventually that the Autodesk, the Dassault Systems, other large companies who operate in this will eventually take some of these, or merge or take some of these companies over. And I think that's where we're actually heading. So and the pace of acquisition activity for RWI has been actually increasing. So I think they're just starting to really capitalize on this trend now, because Autodesk is definitely full on board now with the transition, and I think that this is creating a lot of opportunity. If you looked at the last report that RWI just reported a couple weeks ago, there was a little. They went dark in 2015, so there's not much information on them, but they do report financials in the OTC. So when you looked at the quarter that they reported was of 65 million for the quarter, was sequentially up from about 40-some million. This is Q3 versus Q2, and I didn't know where that came from because they had not. They usually put releases out talking about acquisitions they made. Well, if you look at the cash flow statement that came along with that OTC filing, you'll see a little line item in the cash statement saying under cash flow for investing that appears that they made an acquisition. So I believe that run rate will continue going in the future, and I believe they'll make more acquisitions to continue to grow the company, and very aggressively. So I'm going to show you here, before I get to the big, hairy, audacious fact, some more things that support RWI staying around and being a partner for Autodesk, or maybe even merging with them one day. They've won Autodesk Top Award for 6 straight years in a reseller award for 6 straight years now in a row. So I think that's really a testament to how much they're valued by Autodesk. So let's go over to this. This is my favorite thing here. So what I had noticed when I came across stock recently again was that the revenues over the last several years had kind of been growing, a little flat. They've been profitable for a while. But what I noticed was that the SG&A line was kind of flat, even as revenue was kind of bouncing around a little bit. And I thought, okay, well, if these guys get to a certain revenue level, maybe earnings per share will start really accelerating. And I was curious what that was going to look like. And if you look at this, this is an annual representation of the SG&A expense over the last several years at different revenue levels. And this is what I noticed on a quarterly basis since in the recent few quarters. And as you see, it seems that they have reached a point where they have a lot of operating leverage here. And as revenues increase, they're going to get a much more increase in EPS from that. The Q3 numbers that they released for March showed that the revenues were at 65 million. I think earnings per shares came in at 14 cents. All those were significantly higher year over year and sequentially. And you're seeing the third quarter I think was an incredible inflection point where we're going to start, which should hopefully tell us what's going to happen here going in the future as they keep growing revenue. And I also believe what's going to happen here too is that as this consolidation goes on, as they're competing, their gross margins have come down a little bit because they're fighting for pricing to gain market share because you got to be big to stay in that top 5 kind of standing with Autodesk. I believe eventually when this whole consolidation thing is over, that we might be able to see gross margins kind of come back up again. So you have double whammy effect eventually too on that. And another interesting thing here before we go to the next company is that this whole move from not only does the Autodesk change in its model help increase the ability for RWI to go out there and capture market share from acquiring other resellers, but I believe it's going to bring some customers that have been part of RWI, because RWI gets revenues from getting commission revenue from selling a license, and it gets 2 other pieces of revenue which are more like support revenue. They're recurring. So about half the revenue I think was recurring. Last time I looked, when you look at, I could say for sure from the support kind of revenue. However, I wasn't sure about what's going on the top line revenue, how that really works. But I'm guessing here, because I haven't talked to the company yet, that a lot of companies that they have gotten revenue from in the past, because of the Autodesk, because they purchased Autodesk software, are now going to have to re-up and start, join the SaaS platform and bring more revenue through that commission channel. So that there's some dormant revenue that was sitting there probably that the company will be able to tap into here for some time maybe. So I'm looking into that too a little bit right now. So I think that once, let me go back to the value, over here. I think that once this consolidation process continues, you're going to see some of these. You know, it might look fair value. You know, PE 21, maybe it doesn't look that cheap, but when you start getting these companies that are starting to really capture market share and become so dominant with little competition, I think we're going to see these the valuation ratios really, explode. And I think these are going to come way down too. And so it's good.
Maj, do you think, would you be surprised if the company doesn't get bought out in the next 12 to 24 months?
I think they're going to. I think something's good. I think they're either going to get bought out or they're going to merge with another big VAR. Because if you look at the history of RWI, they've done that a lot. They've merged with other companies to become bigger. But I think it does end in that, and I'm banking on it happening within the next couple of years, maybe even sooner than that.
What type of valuations are these acquisitions usually achieving at this point?
Yeah, that's where I'm kind of trying to grab my mind around where that might be, and I'm thinking somewhere around that 6 to 8 levels where that might price of sales, where it might happen, which I usually wouldn't give to a reseller, but because of the unique situation going on in this industry, I think that's where it's going to be at.
Customer concentration risk?
They're very diversified, extremely diversified. Yeah. Any more questions on RWI?
Kevin Teller, Uninvest Securities. Just considering looking at anything prior to an acquisition, is there any potential for this company to expand its total addressable market, maybe move forward beyond that acquisition?
Yeah, so interestingly, that's a good question because most of their business right now comes from North America. So there's this whole opportunity for them to go global, and that might be an interesting acquisition because it could be a situation where two VARs get together, because one of their major competitors in the top 5 only has presence internationally. So there could be a great merger there possibly there too. So that's a great question.
What management is making in compensation? I see insider ownership is not that much. But
Yeah. I put that there because I didn't know it. I don't know it yet because they haven't filed in a long time, so I'm still looking at their insider ownership and their compensation. They've basically report their numbers on OTCmarkets.com, but only sales, earnings, a few things. They really don't get into the compensations. They don't get into details, so it's tough to say. But they had a lot of insider ownership before they went dark, so I would assume it's up there. Well, then the next one here, which I know Luigi likes a lot.
Well, no, I was just going to say, can you not pop in Ian Castle, which is he'll show us a stock that was 30 cents, and then he'll pitch it to us at $4.
I knew you would say that.
And then you'll see it and it's at $4. That's what Ian does.
I'm saving one of those for you today.
Okay, thank you.
But sometimes your best stock to buy is the one you already own.
That's true. No, but I want to see something that hasn't done this.
That's the third one.
Okay, awesome.
it's not the second one.
No, not the second one. No, not at all.
Is the market still open? Oh yeah, we have 39 minutes.
Chris can let us. So we go over here. Let's go here.
Watch is my largest short position.
There you go. I hope so. I hope so.
Awesome, yeah.
Now they came to your conference.
No, you made my dad.
Yeah. So this is one of my favorite stocks, and I've held for a long time. I bought this thing, Repromed. I call it Repromed, but it's called RMS Medical. I bought the stock, I think it was 2006, at a much lower price than where it is today. It's trading at $1.50, $1.60. And this is a pretty interesting story. So what does Repromed do? RMS Medical do. So are you familiar with infusion pump therapy? Or I'm sorry, infusion therapy, not pump, infusion therapy? Okay, so basically infusion therapy is a way to bring medicine into the body through various mechanisms. You can do it through using needles and other ways, but RMS does it through a very unique way. So a typical competitor for RMS would be a company that has an infusion therapy product, that is electric. So you gotta plug it in where it works in a battery, and then you stick yourself with a needle into your vein. So that's how it works. So I called RMS in 2006 when I bought the stock. I tried reaching the CEO, and he explained what was going on, how the company was, the company's product. And I thought, this is pretty interesting. So their pump is called a mechanical pump. It doesn't work on battery power. It doesn't work on electric power. So it's this weird, tubing system. It works on leverage and tubing, and the needles are not. They're subcutaneous, so you don't have to prick yourself in your vein. So what does that mean? So when he was describing that to me at that time, I thought that's pretty interesting. I mean, they were only doing like a couple million, maybe $1 million in revenue at the time, or what was it, million revenue a quarter, something very minuscule at the time. And I said, well, that seems like a great technology. Why is this such a small company? And I didn't understand. I understand now why that answer is. But I didn't understand that, and we'll get to that later. But what I was thinking was home health care is one of the best places to be at right now. I think home health care saves the healthcare the healthcare system money. So companies that are addressing that opportunity, I think, are really in a good position. So I decided to just buy and wait around a little bit. The CEO at the time, Andy Seaflon, had a really passion for the business, loved what he was doing. He understood the patient and what they needed. When I would ask him questions about growth or how much money you're going to make, he just want to talk about the patient. We're trying to build the best product for the patient. And fast forward today, they have I think a 28% market share in their core market, which only has a 25% penetration right now. I'll get that in a second too. So the company has a good deal of recurring revenue. It's a razor blade. So they sell the infusion device, and the razor blades, are the subcutaneous needles, and you have to keep reusing them. And we're going to get the big, hairy, audacious fact is going to show that later. And that's right. Now, since I've owned the stock, they've only raised money one time. It was a very small raise. I really appreciated that. Then in 2014, something happened. Joseph Manco of Horton Capital Management invested in the company. I think it was a raise that he got involved in. Okay. So, we're not going to get a third one, by the way. And so he came in as a passive investor. He didn't want to be active at all. And in 2015, end of 2015, the company dropped a bombshell. They received an FDA warning letter, and regarding one of their products. They could keep operating the business, but they had to address this warning letter, and if they didn't, it looked real ominous. So eventually, Manco became activist. He said, "This is ridiculous." He wanted to get clear. Why did this happen? Why? And what's amazing was the company had that news had been on the FDA website for maybe a week or so, and they only issued the release after that. So and Manco was buying. So he didn't even know this was out there. I don't think. It was. I think he really got upset. I was pretty mad, but they got through it. So I didn't know they were going to get through it. I couldn't sell it because it became too illiquid at that point. And during that time, though, Joseph Manco got on the board. He kept buying stock, so I kept buying stock with him. And he was buying stock at 30 cents, 40 cents, 50 cents. Now he's buying stock at $1.50. He was the only one buying stock some days, I swear. So he came in. He helped get that process done with curing the warning letter, which they did. I think it wasn't with maybe end of 2017. He found out that the company was just wasting too much money. The CEO, there were some perks the CEO and the board were taking. Cut that loose. Make some management changes. CEO's gone. Brought in a new management team that has industry experience. That now, during Andy, the CEO's tenure there, he wasn't doing much marketing at all. He wasn't putting much into R&D, and so Joseph basically is changing that now. He's spending more money on R&D, getting more money on marketing. And what they've done right now is they've basically taken this product. They're about to expand the market. They were playing in a very narrow field of drugs that could be infused to their product. So this market's probably has a potential to expand from 500,000 to well into the billions, if this subcutaneous thing really catches on to things other than what they're doing right now. They're right now talking to pharma companies. They can't get into details, but who are testing the system. And another interesting thing is, for the particular drug that's being infused right now, that's only 25% of people who are diagnosed with this, who probably have this, are actually seeking treatment. There are several drug companies now that are attacking that market, and once that happens, there's going to be more awareness and more diagnosis of this disease. So that's going to be a really cool event. There's a lot of things going on. They're going to get organic growth from their core drivers of the drugs they've been infusing, and they're potentially in the near future here about to get expand the market and have other drugs come through their system. So I think, to me, it's a no-brainer. I think what you're going to see here, I think the stock, once it gets to $2, hopefully they'll go for a listing on the NYSE Amex. Like many other recurring revenue models, SaaS plays we've seen do that. I think the evaluation multiple could really explode, especially if revenue starts to accelerate. Because right now revenue is growing about 15, 20, 25%. But if they can really ramp it up, they are going through a lawsuit right now with a competitor, which they've won most of those battles. There's one more battle they're going through, which should be kind of coming to fruition this year, hopefully, at some point. But I think they're going to win the battle, though.
Has your research concluded that the highest valuation that anyone pays in microcap are med device companies that are razor blade business models?
I think recurring revenue is the key, for sure. But the medical device, it's no doubt about it. And especially now.
Well, I was going to tell you, Maj, we saw that companies that were actually growing top line, when they got to profitability, they usually commanded anywhere between 7 and 10 times sales.
Yep.
Now, there is variance based off the specific segment of healthcare, but where do you feel that if these guys actually build this thing out, that something like that is achievable down the road?
Yes, I think that's the range, and I wouldn't put a question that against outside that range, because look, they already have a 28% or market share in what they're doing. So with these companies that have that kind of dominance, once the revenues get big enough, I think it can actually command maybe higher multiples than that. But I'm not going to model for that, but I wouldn't put that out of question, yeah, for sure. Well, so ATGN is a typical cloud communication company. Like think of a Ring Central or an 8x8 transitioning from a hardware on-premise licensing model to a pure SaaS cloud type model. It's an awesome story. If you can go on, you can go and read, listen to the presentation on Chris's website where they did a presentation, and I would really encourage that. I'm going to show you this. 1 second, just the one slide that tells it all real quick. That's a slide. Oh wait, no, that slide tells it all. You see their cloud revenues increasing. All the metrics, customers, subscribers, cloud revenue is in the right direction. They've been going through this turnaround since 2013-14. They finally inflected, and I think they're one big event or one big partnership away from revenues really taking it to another level. This again can be the situation. They're on the OTC. Could be one of those things where you get an incredible expansion of multiples if it gets listed, and they're definitely working towards that. The last stock, whoops, this is the one that hasn't done well, is DHX. So this company very quickly is a hiring platform marketplace where they help companies search for employees, obviously, but the way they do it is different than any other. And I was going to play you a tape, a recording from the presentation that they did at Roth. But I'll just tell you that they're going through a multi-year transition. A new CEO came in 2018, has reduced debt tremendously since 2018. He sold underperforming assets, came in and had a focus on their core career marketplace platforms. And they have 3 platforms now, 3 marketplaces. Their legacy platform is called Dice, which has a great presence in the market. It's a leadership position in the market. Their other two platforms have decent presence, but they don't operate the same as efficiently as Marketplace. The Dice has a great way of analyzing data, giving their customers big data analytics. So real quick, for example, if you're an employer, you're looking to hire somebody, a lot of competing marketplaces will just throw everybody at you that applied for a job maybe or something, or looking for a job, or have certain qualifications that seem appropriate. These guys just narrow it down. They just give you the best people that their data tells you that you should be looking at, so it saves on time. So they're taking that Dice code in their software, and they're putting it in the other two marketplaces. Each marketplace serves a different area. Technology is one. Technology, defense, companies, and financial sector. They became very focused, and I think they're right at almost 100% of recurring revenue. And I think once the market understands that, sees that debt levels are coming down, they're going to probably be debt free soon. That you're going to see this, of course, get incredible expansion in multiples. And here's what some of the things look like here. So that's it. So I can share and talk with you about those two stocks if you want anytime. Also, you can reach out to me at Maj at GeoInvesting.com, and if I can send you some research I have on all these stocks, and if you want to learn more about them. Thank you.